Welcome to Markets Now. I'm Michelle Rook with Mike Zuzolo, Global Commodity Analytics. And grains ending mixed on Tuesday. We did have corn and wheat higher, soybeans lower. Mike, let's start off talking about the wheat market. It led the charge higher. That lower crop rating at 38% good to excellent was kind of alarming, wasn't it?
It was. It surprised the trade. And if you live near the wheat belt, the hard red wheat belt, it's not a surprise. I've had some clients who are also crop insurance agents, adjusters, suggesting pretty strongly that this wheat crop is A, not getting in the ground, and B, not getting up. And you always hear that term, plant in the dust and the bins will bust. Well, that is if you get rain. And I think that's a key element to what the market now understands here in the United States, and puts us along the same lines as what's been going on in the Black Sea, Michelle. So I think it was a wake-up call. It was nice to see the wheat market do what it did. That the emergence, it was even worse. We came in at 56% emerged versus 61% last year at this time. States like Nebraska down double digits, I think 12 points below. Oklahoma, we know, has had a lot of problems. It's still down 17% versus last year. And then I think rounding out the double-digit losses on emergence with South Dakota down 10 points. It's a very wide-ranging issue on the emergence, and really I think kind of told the market very clearly we've got a drought and it's really starting to impact us. And this is going to be a really critical next 10 days because we've got a lot of rains forecasted on both major weather models, but I'm starting to wonder if we're even going to get it in the ground because we've got a lot of prevent plant dates coming up in some of these key states as of the end of this week. So what if you get 4, 5, 6 inches of rain and you just can't get it in?
So do you think we need more weather premium in this market, and will the funds help maybe put some in there, because we did get above some resistance areas on the charts now again, didn't we?
Yes, and I think, for me, the global supply demand fundamentals, if I had to rank the two biggest undervalued commodities out there, it'd be crude oil and the wheat market. And that's by design because the wheat has been taking a negative hit off of the crude oil market. Tuesday afternoon was no different, with the idea that maybe there's going to be a peace treaty or some kind of ceasefire in Lebanon, and that continued to work against the crude oil market finding any kind of base of support. And it seems like the wheat's really attached to that crude oil market along with those other more negative supply demand fundamentals. But trade continues to work away from the positive global supply demand fundamentals, and I still put wheat as the leader to the upside in price trend change in the grain complex and the soy complex, because the drought that we've had and continue to have, I think, is having a material real hit in production aspect to this market.
And the corn market was a bit higher. Did it just follow wheat? Was that strong demand, or the fact that crude oil at least wasn't imploding?
Yeah, I think the crude oil was a big player, and I think that spread, the wheat corn spread, has been getting pounded pretty hard, wheat minus corn. It's nice to see that firm up. I wonder if there wasn't probably some unwinding of that spreading, and the corn wasn't able to take out its weekly high as a result of that. But with 80% or so harvested now and basis starting to come up, our basis here in Atchison, I think, jumped 6 or 7 cents on Tuesday. I think we're starting to feel that strong export demand, along with the end of harvest, is going to probably bring the cash corn market back around. But I do have to really watch the Mississippi River and the drafts, because those are continuing to really be hit pretty substantially. So we're going to have to keep track of the actual physical inspections.
Yeah, I know there are some headwinds there, even though we've had strong demand. From a technical standpoint, also talk about what are the funds doing right now? Are they going long, short? What are they doing? And why can't we get December corn above like the 20 and 100-day moving averages?
I think net, the funds want to stay net short the corn and the soybeans and the wheat. And in the corn and beans, even with this terrific demand burst that we've seen on the export sales here the last 2 or 3 weeks, but that I think the trade's gotten into their heads that the Chinese are buying extra beans, the Mexicans are buying extra corn, worried that their currencies are going to weaken substantially after the November 5th election, and the dollar is going to become a safe haven and go sharply higher. And so I think that's why they're going to want to try and stay net short mostly, but they're really not wanting to get too exaggerated on the net short position, and that makes a lot of sense given the price erosion we've already seen.
So the soybean market set back on Tuesday. Is that the trifecta. You know, you've got South America with better planting, Chinese economic concerns. There's a lot of things going on in that market.
There really is. And I think this is where you can kind of connect the dots with China and the soy meal market, because the soy meal market in China hit its lowest level since June of 2020. For the last 5 weeks, the US CME meal has gone down, and it's really been led very clearly by the Chinese Dalian futures. And I think this goes back to the weak demand, the deflationary pressures. You know, Michelle, I don't think many people realize, but China's producer prices have been negative for 2 straight years. They just came out with fresh numbers, 24 straight months of negative producer prices. And I think this is really key to when it comes to the livestock feeding aspect. And I think that's the real driver in the meal. So if we want the soybean market to find a low as South America catches up on planting, I think we really do have to have those products come back around and support the beans.
We also should talk about maybe some of the technicals here, because you believe that maybe we're going to go and take out the contract lows in beans, but we're also looking at $300 meal as kind of a floor here. Is that going to hold, Mike, with what you just said?
I think we should hold here. I think there's probably exhaustion selling right here. I think the key will be whether we go back to 935 and test those 2024 lows in beans from August. The key will be whether USDA cuts the yield in their November WASDE report, which I think they should, more than what they did this past month, and whether that dollar goes screaming higher and appreciates against the Chinese currency and against the Brazilian currency. Because we think about a trifecta, that would be the worst of both worlds. If the Brazilians get back on track on bean planting, China loses their buying power with us, Brazil increases their selling power with China. That just kind of leaves us out until Brazil can get more beans to China. So I think it's a real issue, Michelle, but if the meal would find a low, I don't think we need to go to another 30 cents lower in the beans.
Well, let's hope that's the case, because funds, I think, have been pushing back on the short side of that soybean market for all the things, all the reasons that you have been talking about. In addition to the election, are there concerns about the outcome of that?
Yeah, and I think that's why we've seen some pre-buying in China. I mean, the livestock numbers don't add up. The crush margins have now turned negative in both key areas that I keep track of over in China at this stage of the game. And so for them to buy extra and put out what was it, 49 million bushels or something like that in terms of weekly export sales last week, I think that's fear buying because of the election.
So let's talk about the cattle market. Some new highs for the move in the December live cattle anyways, but we were up into resistance. Is that why we saw maybe a little profit-taking setback today?
I told clients late last week before the cattle on feed report, I really wanted to see on feed numbers below 11.5 million. We came in with almost the exact same level as last year at this time. So we have ample supplies in that report. The cold storage up 6% in beef versus a year ago. Ample supplies there too, Michelle. So I was looking for a feed the bull type mindset out of those two reports. I don't think we got it. And I'm a little nervous, as I said, about both the politics and the election and the funds being so long fats, but also that demand season on whether we can really sustain a 190 cash price through December, because USDA is at 186 for the fourth quarter on steer prices. I'm a little bit higher than that, but I have hit my overvalue levels and have started to put some Q4 hedges in place.
Let's talk about the hogs, more highs, and we continue to see that market being pushed contra-seasonally. What's behind the push there? Is it supply? Is it demand? Or is it just funds?
I think it's mainly cash and some funds. I don't think the funds really want to play into the long hog market too aggressively until they get the all clear in China. And the China stimulus has just not been what the trade has wanted. I really think that cold storage number, unlike cattle, did feed the bull when it came to 40% less pork bellies than a year ago. I think that was a bit of a shocker to the trade. We also, I think, slaughter-wise, have a little bit tighter slaughter pace than what maybe the trade was expecting, as now we are in the fourth quarter. But as I said, we've had a really good run. There's probably some fat in the hogs right now, and I think they may be right there on the ledger ready to get some hedges in place for Q4 in the next week or two for me.
Okay, good advice. Thanks so much for joining us, Mike Zuzolo, Global Commodity Analytics. And that's Markets Now.